You wake up, commute, work your 8 hours, and go home. You follow the rules, but still feel completely exhausted and financially stuck. That exhaustion comes from the exact equation we are handed in school: get a secure job, work hard, and save whatever is left over. Plotting this equation on a graph, the line representing your fixed wages moves at a slow crawl, while the cost of living curves aggressively upward. A standard job might give a 3% raise, but assets grow at 8 to 15% a year. It is simple math. You're trying to build wealth in an economy where the cost of living keeps speeding up. Over a long enough timeline, relying on a linear salary guarantees you will fall behind inflation. That paycheck covers your immediate survival, but labor alone only generates income. To actually build serious wealth, you have to transition to ownership. The people who actually build wealth focus entirely on acquiring self-sustaining assets. They operate on an entirely different balance sheet. The most direct path to leverage is business. A business completely detaches your income from the physical limitations of a 24-hour day. Whether it is a software company, a digital agency, or an online brand, a business scales independently. It continues to process orders and generate revenue while you are asleep. If you aren't building a business, buy into them. This curve shows stock market compounding over 30 years. Your initial principal is tiny compared to the massive compounding interest stacked above it. You simply buy index funds and let the math work. Both businesses and stocks do the exact same job. They replace your limited human energy with scalable, self-replicating financial systems. The third asset class of ownership relies on a completely different mathematical advantage: using other people's money. This chart shows real estate leverage. Your small initial capital controls a massive property, while the tenant's rent continuously erodes your bank debt. Simultaneously, the property expands in value through appreciation, and built-in tax advantages protect your cash flow. The math of these three asset classes is incredibly straightforward. The reason most people never use them is entirely psychological. We are conditioned to buy things we can show off: expensive cars, luxury clothes, status symbols. These are visible liabilities that drain cash flow. True millionaires do the exact opposite. They drive normal cars and live in normal houses, while quietly accumulating unglamorous, invisible assets. 20 years ago, building that invisible balance sheet required massive capital and passing through corporate gatekeepers. Now, look at how a single online platform can instantly reach across the globe. That represents the scale of modern technology. Today, a single person with a laptop can deploy AI, automation, and digital platforms to reach millions of people instantly. The barrier to entry has collapsed. To start utilizing this, you need to aggressively increase your upfront income by learning high-leverage skills like AI implementation or sales. Then immediately divert a portion of that cash into consistent investments. But there is a crucial defensive maneuver you have to execute. When your income rises, you must resist the urge to upgrade your apartment or buy a nicer car. Lifestyle inflation will wipe out your leverage before it even begins. You have to accept that true wealth creation requires long-term discipline. The day-to-day process of buying assets is incredibly boring long before the math becomes impressive. It ultimately comes down to how you view a dollar. The middle class views money as a currency to buy social status. The wealthy view money strictly as a tool to buy back their own time. Once you understand the mathematics of ownership, you stop trading your life for a paycheck, and you finally force your money to work for you.